Hi, I'm Justin Zaks, Vice President of Strategy at Moomoo Technologies. I'd like to welcome you to the fourth webinar of our monthly 7-part series entitled Experience Options Like Never Before. This series will give viewers an exclusive opportunity to learn about a variety of topics related to options from industry experts at the Cboe. I will also be asking Cboe experts about their presentation, their professional lives, and their view on various options topics. You, the viewer, will also get a chance near the end of the webinar to ask questions, so make sure to watch the entire show. I wouldn't want you to miss anything. The presentation should be about 15 to 20 minutes, followed by questions for about 45 minutes total. The webinar is part of a broader collaboration between Moomoo and the Cboe that includes several in-person events and the introduction of index options on the Moomoo platform last November. Today, I'd like to welcome Mandy Xu, Head of Derivatives Market Intelligence at Cboe. Mandy provides analysis and insights on derivatives and how they influence markets. She's particularly focused on speaking about volatility generally, as well as Cboe's volatility products, including the VIX. The title of her presentation is Volatility in the VIX Index. Mandy will educate us as to what volatility is and what it isn't, and tell us about the different types of volatility, such as realized volatility and implied volatility. She'll also tell us how to trade volatility and tell you all about the VIX index, futures, and options on the VIX. These slides will be available in the webinar chat, and a replay of the video will be available in-app for the next 24 to 48 hours. Afterward, it will be on YouTube in about a week or two. Before we begin, make sure to go to moomoo.com/US to check out our current sign-up promotions if you're not already a client.
Great. Thank you, Justin, and thank you to the Moomoo team for having me on today's webinar. I'm very excited to go over the topic of volatility and volatility products with a particular focus on the VIX index, which is the benchmark measure or an index for measuring volatility. So before I get started, in terms of logistics, I think Justin already mentioned, I'm going to try to keep this presentation fairly brief, about 15, 20 minutes, but then we'll open up to Q&A. And so I welcome any questions on topics I cover here, as well as things I didn't mention that you're curious about in terms of volatility, and particularly around the US index products. So without further ado, let's get into it. The question, what is volatility, right? I think that's something that I think most people intuitively understand. And what I have shown in this first slide is just two charts of two different stocks. The first is NVIDIA, and then the second is Coca-Cola, right? And just by looking at the charts, if I asked you which stock is more volatile, I think everyone will understand, can grasp that NVIDIA is a much more volatile stock. It generally moves more. You can see this is a year-to-date chart. It's gone from, sub $60 to now over 120. So it's doubled in value in the last 6 months. Versus, say, a stock like Coca-Cola that's traded in a fairly tight range all year between, let's say, 58 and 62, right? So visually, I think it's pretty obvious, like, what is volatility? But there's ways to quantify volatility, right? So when you're trading options, people like to talk about volatility and like to be really specific about, what's the level of volatility, what types of volatility are we looking at? So the first concept, I think, to introduce, and probably the easiest to grasp, is the concept of realized volatility, which is just looking at how the stocks have behaved in the past, right? And the way that you calculate realized volatility is you look at the daily returns of the stock, and you look at the standard deviation of those daily returns over a certain period of time. So what I put on the slide is the 3-month realized volatility level of NVIDIA versus Coca-Cola, right? So 55% versus 12%. You can see NVIDIA obviously is significantly more volatile. And again, the way that you interpret, so what does 55 mean, right? Like it's a number, but what does it mean? It's an annualized number of expectation for NVIDIA to move about 55% over the course of a year. So that's kind of the level of volatility we're talking about, versus for Coca-Cola, it's 12%. So that's how you interpret the number. And this, again, is a statistical measure looking at previous returns of the stocks, how the stock has behaved in the past. But when you're trading options, there's another concept called implied volatility that is probably even more important, and I want to kind of spend a lot of time today talking about what is implied volatility. So if we go back to Options 101, for those of you familiar with the Black-Scholes model, you'll know that when you price an option, there are 6 factors that go into the price of an option, right? The first 5 are easily observable, right? So they are the stock price, the strike price of the option, the time to maturity, dividends, and the risk-free interest rate. All of these factors we can kind of see and observe. There's a 6th factor that go into the price of an option that's called implied volatility. And that is not easily observable, right? So, what are you trading? Because when you're trading an option, it's forward-looking. So what is the volatility of a particular option, whether it's NVIDIA or S&P index? Say if we're trading a 3-month option, what's the 3-month volatility going to be for that option? We don't know. So the way that we calculate implied volatility is actually through backing out of the option price, because we can observe the option price and we can observe all the other 5 factors. So kind of holding all those constant, we can back out what the implied volatility must be for that option, given where it is currently trading and given all the other parameters which are fixed. So that's implied volatility. And why does that matter? Well, implied volatility, unlike realized volatility, gives you the forward-looking expectation, right? So it tells you what the market is expecting volatility to be for that underlying for the next, 1 month, 3 months, 6 months, depending on the tenor of the option that you're looking at. So that's where the value is. It has a forward-looking aspect to it versus realized volatility, which is a purely statistical observation. There's no debate. There's no, it is what it is. It's you just calculate the standard deviation of returns. So realized volatility by definition is backwards looking. Implied volatility is by definition forward looking. It's derived from an option price. So what I've shown you on this slide and this chart over here is just a very standard implied versus realized volatility chart for the S&P 500 index, SPX, right? In this particular case, I'm looking at the 1-month implied volatility. So looking at the implied volatility of 1-month options on the S&P compared to the backward-looking 1-month measure of realized volatility. And I'm looking at both these measures over the past year. So it's a time series of volatility over the past year. When you look at this chart, a couple of interesting observations, right? And I think this will get into some of the themes that we're seeing in the market and what people are talking about right now. So if you look at the blue line, which is the implied volatility line, what you'll see is that right now, implied volatility is extremely low, right? So the 1-month implied vol is hovering somewhere around 10%. And compared to where it's been trading over the past year, it's near a 1-year low. So volatility is very low. Implied volatility is low. Now, if you look at the gray line, which is realized volatility in the market, again, this is how the market has actually behaved, you'll see it's even lower. So the gray line, the realized volatility, right now, the 1-month realized vol is around 5, right? And if you actually, I'm showing the 1-year history, but if you go back multiple years, what you'll find is that the realized volatility level is actually at a 4-year low, multi-year low. So in other words, as low as implied volatility is, realized volatility is even lower. And that's important for people who are trading options when they're trading volatility, because when you're buying an option, you're buying the implied level, right? The implied volatility, but what you're getting subsequently is the realized level. So buying vol, if you will, at 10, may look cheap, right, compared to where it's been trading over the past year. But if it actually ends up realizing half of that, that's what we call actually, it's pretty expensive. It's hard to carry. And that's why volatility traders often look at this comparison of implied to realized. Now, of course, you're looking at the implied now versus what's been realized in the past. And of course, buying a volatility at a level of 10, over the next month, we may have a large market sell-off, realized volatility to spike up. So it could end up being a good trade, but people look at the relationship between the two when evaluating whether or not volatility levels are quote unquote rich or cheap, high or low, to get a sense of where it's currently trading compared to history, where it's currently trading compared to the realized. The other thing that you may notice looking at this chart is that the blue line tends to be above the gray line, right? So implied volatility typically trades at a premium to realized volatility. And why is that? Well, you can think about it from the perspective of an option buyer, who is typically, buying options for insurance purposes, especially in the SPX, and it might be different in other stocks. But at the index level, right, you can think of this as kind of almost the premium or the cost of buying insurance, whereas versus an option seller, if you're selling insurance, of course, you would demand a premium or a cost to kind of that risk. And if we go back to the previous slide, I think this really illustrates why option sellers require that premium or that additional, cost, if you will. If you look at the payout of an option, and over here, this is looking at a standard call option payout, right? Where, in this particular case, it's looking at a call option that's struck at 100. If the stock goes up, you're going to make money, right, with a call option. If the stock goes down, your losses are actually capped, right? It's capped in this particular case at $5, which is how much it costs to buy that option. So it's asymmetric. It's the asymmetry in the payoff that really, incentivizes the seller of an option to really demand more in order to sell you that optionality, which is why implied volatility typically trades at a premium to realize. And that difference is called the volatility risk premium. And right now, that volatility risk premium, as you can see, is extremely high. Okay, so I kind of lay the groundwork in terms of what is implied vol, what is realized volatility. What is the VIX index? Hopefully everyone has kind of heard of the VIX index. You've probably seen it quoted very widely in the financial media. So what exactly is it? What does it measure? So as I mentioned before, it's the benchmark measure for volatility for U.S. equities. And the reason why that is the case is because it's based on options on the S&P 500 index, which is obviously the most liquid and actively traded index in the world. Specifically, it's constructed using options, front and second month options, such that it always has a 30-day constant tenor. So it's a 30-day forward expectation of how much the S&P is going to move or expected to move. And again, all volatility numbers tend to be annualized. So the way that you can convert it to a daily move, a lot of people want to know, well, a VIX of 12 or a VIX of 30, what does it mean for S&P move on a day-to-day basis? So there's something called a rule of 16, which is kind of in the back of the envelope calculation to convert it to a daily move. Is you divide the VIX level by 16, and that gives you how much the index is expected to move on a daily basis. So if you want to convert the annualized number to a daily move, just divide the index level by 16. So right now you can see, for example, the VIX is trading around 12. Divided by 16, it's about 75 basis points. That's how much the S&P is currently expected to move based on its option prices on a daily basis. And in terms of range, you can see, it's right now it's kind of toward a multi-year low. We're in a very low volatility regime right now. If you look all the way back to, obviously March of 2020 during the depth of the COVID pandemic, you can see the VIX got to as high as over 80, right? And that was, almost a record high at that point. So there can be very extreme swings in terms of the levels of the VIX, depending on obviously what is going on in the market. Okay, the second question, and the second section of the presentation, I really want to focus on is how do you trade volatility, right? And there are many ways you can trade volatility. And, anytime you trade an option, you are taking a view on volatility, and there are, dedicated volatility traders out there who trade, for example, levels of implied versus realized volatility. So this is not meant to be an exhaustive, obviously, list of how to trade volatility. But in terms of simple ways to trade volatility, I mean, one of the most common questions that I get is, how do I trade the VIX index, right? So VIX right now is at 12. I think that's too low. I think VIX is going to go higher. What can I do? What kind of bets could I make? What kind of trades could I put on, to express that view that the VIX is going to be higher in the future? Well, in terms of products specifically tied to the VIX, there's not a way to trade the VIX spot index itself, but there are products that are tied to the VIX, specifically VIX futures and VIX options that allow you to take a view on where VIX is going to be in the future, right? So VIX futures, as you can see, this is a futures curve for the VIX. So they expire at different points in time in the future. Here I've listed the monthly contracts that go out all the way to March of 2025 right now. And you can kind of see where the current levels are trading. So the July VIX future currently is trading around 13. The October VIX future is around 17.5, et cetera, et cetera. So you can see the level. So that's kind of where the market's expecting the VIX to be at the different points in time. You can buy these futures, you can sell these futures depending on your view of where volatility is. So for example, you look at the October VIX future at 17.5 and you think, look, I think that's too low. I think volatility is going to be a lot higher in October. You can buy the VIX October future at 17.5, and then come October at expiration, let's say VIX is at 20.5. So you make 3 points. The multiplier on a VIX future is $1,000. So 3 times 1,000, you make $3,000 based on one contract of VIX futures. Conversely, if come October, VIX is at 14.5, you lose $3, you're out $3,000 in terms of the notional value. So you can make or lose money depending on where VIX is going to be in the future, right? So that's kind of one way to trade the VIX. If you look at this chart, a couple things that stand out. The first is that you'll notice that volatility levels, the VIX futures levels, tend to increase as you go out further out in time. And that's pretty typical. So when we talk about the VIX futures curve, we say it's typically upward sloping, or another term that you might have heard of is in contango, right? And that means the volatility levels in the future are higher than volatility levels today. And the intuitive explanation for that is that if you think about implied volatility as measures of uncertainty in the market, then of course, uncertainty, you're more uncertain about where the market's going to be, a year from now versus say a month from now, right? Or a week from now. A month or a week from now, you think it's probably, S&P probably going to be where it is trading today, up or minus, 1 or 2%. A year from now, there could be much bigger swings depending on obviously a lot of factors that can happen in the meantime. So uncertainty naturally increases as you go further out in time. Therefore, implied volatility levels tend to be higher for options of longer maturity than options of shorter maturity. So that's number one. The second thing that you might notice is that there's a little bump over here. Right, I mentioned the October future. So you can see the October future at 17.5 is trading significantly higher than the September future, and is actually trading higher than even the November future and the December future afterwards. So there is a bump or a kink in the VIX futures curve, and this is no coincidence. It's been there actually for a while now, and this is really on account of the U.S. election, right? So we are currently seeing about a 2.5 vol point premium for the U.S. election. 2.5 because the September is at 15, the October is at 17.5, so about 2.5 point extra volatility being priced in for October on account of the U.S. election, because we typically see volatility pick up going into the U.S. election. So that's another kind of noteworthy thing that we're seeing in the volatility space, is that already people are starting to price in more volatility for the U.S. election. And this is unusual in the sense that in prior election cycles, you didn't see as big of a premium being priced in this early on. So for example, in 2020, at this point in the election cycle, there was probably only about a 1 point premium. So we're at double that. And in 2016, also, there was not as big of a premium being priced in for the election. So I think, based on what has happened in the last 2 elections, I think people have kind of seen that it can indeed cause pretty big spikes in volatility, and started pricing in more volatility for the election earlier on than what we have seen in the past. Now, it's not always the case that the VIX futures curve term structure or curve is upward sloping. It can at times become inverted, meaning it can be downward sloping. And the other term for it you might have heard is called backwardation. So the curve could be backward dated, which is just another way of saying that front month futures or short dated futures trade at higher levels than longer dated futures, right? So in this particular case, I'm taking a snapshot of the VIX futures curve from March of 2020, again, during the depth of the pandemic. You'll see the VIX spot index at the time was trading around 80. The April future at the time was around 70. And then as you go progressively further out in time, the volatility levels actually decline such that, the October, November, December contracts were around 30. So that's a backward dated VIX futures curve. And that is pretty rare. It generally happens during times or periods of crises where there's extreme uncertainty in the near term, whereas in the longer term, people think or figure, believe that things will normalize. So, if you can remember back to March of 2020, this was a time of obviously COVID rapidly spreading. No one really knew exactly kind of how quickly it was going to spread. There was, wide, ranging government shutdowns, lots of kind of questions around the economic fallout of that. And if you recall, S&P index itself was moving, like sometimes even 10% in a day. So it was a period of extreme volatility. And that's why you're seeing such high levels kind of in the front of the curve. But further out in time, I think people were expecting things to normalize. And that's why you see that curve being backward dated. Okay, so as I mentioned, you can buy VIX futures at different points in time to kind of express a view of where volatility is going to be in the future. The other thing that you can do if you want to trade the VIX or trade VIX-related products is trade VIX options. And VIX options, I think there are a couple things to really highlight, and there are some very common misconceptions. So if you look at this table over here, this is just a pricing table of VIX options. And the first half is looking at the August 21st expiry. The second half is September 18th expiry for VIX options. The reason I pull this up is, when I snapped this, VIX was trading around 12.4, so like right around 12 and a half. And if you look at the August 13.5 put, which I've highlighted in red here, it was trading roughly, let's call it 80 cents, right? And that might confuse a lot of people initially because a 13.5 put, when the spot is at 12, let's call it 12 and a half, should have been worth at least $1, right? Because that was the intrinsic value. Plus you have, the time value to expiration, so it should have been worth at least $1. Yet it's only worth about 80 cents. So I get a lot of questions. People look at where VIX spot is trading, where VIX options trading, and say, well, this doesn't make sense. And really the key thing to emphasize here is that VIX options are priced not on the spot index, but rather on VIX futures, right? So what I've highlighted here, over here, is the equivalent VIX futures level. So the August VIX future at the time was trading about 14.2. So actually a 13.5 put was out of the money. And that's why it was, it's worth a lot less than what you would expect had you just looked at the VIX spot index level of 12.5. So that's a key thing to keep in mind, is that options are priced on the price on the future, not the spot level. The second thing to kind of mention or talk about or discuss with VIX options is that the volatility level or implied volatility level of VIX options tend to be a lot higher than that of SPX options, right? Which again, maybe not surprising given volatility is a very, it moves a lot, right? As we saw in the previous chart, can go from 12 to 80, in the span of a couple weeks. The implied volatility in this case of a VIX option in the 13.5 put is about 60, right? So before we looked at, S&P implied volatility of 10, VIX implied volatility of 60 is significantly higher. And if you want to kind of track or follow VIX options and you're interested in trading VIX options, the one index that you should always have in front of you is our VVIX index, which is the volatility of the VIX index. So this, similar to how the VIX index measures 30-day expected volatility of the S&P, right? Because it's based on options on the S&P, the VVIX index measures the 30-day expected volatility of the VIX index based on VIX options. So what you'll see right now is that VVIX index is trading around just under 80. It's pretty low, right? It's been a lot higher. So you can see a spike, for example, in April of this year to 110, and almost to 120 late last fall during the market sell-off. So it can definitely vary a lot as well, but generally it trades a lot higher than SPX options, or trades a lot higher than the VIX index. And that's because volatility is a much more, I hate to say it, but VIX is a lot more volatile asset than S&P index itself. So that's why VVIX is a lot higher than the VIX index. In terms of themes that we're seeing in the VIX option space, one thing to highlight is that we're actually seeing record volumes in VIX options. So what you'll see in the first chart on this slide is just the average daily volume of VIX options over the last couple of years. And what you'll see is that last year we saw a 40% year-over-year increase in VIX option volumes to an all-time high. And actually this year we're on pace to even beat that or exceed that record to a new high. So a lot of questions I've gotten around kind of what is driving the extreme interest and activity that we're seeing in VIX options. Part of it, I would say, obviously, is the fact that VIX is so low. A lot of people are interested in kind of making trades or taking bets on basically taking the view that the volatility is going to be a lot higher. So they're buying VIX options as a hedge. And I would say particularly VIX options are good tail hedges, because what really drives big spikes in VIX are big like black swan events, right? Like, March of 2020 or the global financial crisis. These are the type of events that kind of come out of nowhere that really hit markets, that cause a huge explosion of volatility. And given where VIX is trading right now, there's a lot of kind of interest in buying those upside calls in the VIX as a tail hedge for portfolios in the case that we do get hit by a black swan event. In terms of potential black swan events, one thing that a lot of people are looking at right now is obviously the geopolitical environment. And what is notable is if you look at this second chart, which looks at the daily VIX option volume, what you'll see is in April of this year, we actually had on that day when Iran and Israel were shooting missiles at each other, over 2.6 million VIX option contracts trade on that day, which was higher than any point during the March 2020 pandemic, as well as last year's regional banking crisis, which I thought was really pretty incredible, given especially in March 2020, VIX hit a high of almost 90. Where we're just seeing some really incredible volumes in VIX options right now on the back of potential black swan or fears of black swan events or interest in hedging tail risk from a lot of traders and investors. The last thing that I'll highlight before I turn it over is just, I get asked this question a lot, which is, are there volatility indices for other asset classes or other tenors, right? So if I want to know where S&P volatility is trading, I look at the VIX. What about for other asset classes? So we actually have come out with a suite of volatility indicators. So we have a family of credit VIX indices, if you will. VIX IG, for example, measures 30-day implied volatility of investment grade CDX credit default swap spread. So if you're trading credit, that is definitely a good index to look at. VIX is a 30-day measure. Given all the activity that's gone on, for example, in zero-day options in SPX, a lot of people have asked us for an indicator for shorter dated option activity. And last year we came out with VIX one-day index, which tracks the one-day implied volatility of the S&P. We also have equivalent indices for 3 months, 6 months, as well as 1 year. So I've left the tickers here if you want to follow it. And again, these indices are not tradable, but they are good indicators to give you information around kind of the expected volatility of the different asset classes. And the last thing is that, we do publish both weekly commentary as well as thematic commentary on what's going on in the volatility markets across asset classes, as well as focusing specifically on equities. So if you are interested in subscribing, I've left the link here. You can sign up to be on our mailing list. And with that, I'm going to turn it over back to Justin and open it up for Q&A.
All right, thanks so much, Mandy. That was a really informative presentation. I know a lot of our A lot of the comments I've already seen. A lot of people really like your presentation. We're going to delve a little bit more in there. Please keep the questions coming. I won't be able to get to everyone's questions, but we will try to get to a bunch of them, and I'll try to combine a few of them together. And also, just please remember, this is a 45-minute presentation. You're not going to master volatility in one session. It will take a while. Moomoo has great resources. Cboe has great resources. Please use both of us to learn about more about volatility in the VIX. And you might not get all of it, might be a little over your head, but we're going to get into a few of these complex topics, but hopefully we'll also explain some of the more beginner type things as well. And getting into that, I'm already getting questions about the current vol levels, which you mentioned are low. And a lot of people are wondering, why are they so low, and why is, this next month they don't expect to have a lot of volatility? Is it only because realized vol has been low recently, or what could be some of the other reasons? Are there people just selling volatility every day, or?
Yeah, no, that's a great question. And it's probably the most common question that I've been getting so far this year is, are there factors that potentially may be suppressing volatility, right? Because people look at VIX at 12 and they'll look at still the uncertainty in the macro environment, and then they're saying, well, like, this doesn't make sense. And of course, you mentioned kind of the vol selling activity. That's been a big trend in the derivatives market, particularly, I would say, with option income funds. We've seen a lot of growth in that. So a lot of, either people implement it themselves or they put money into ETFs that sell options for income. And people look at the growth in that strategy and say, could that be a reason why VIX is so low? It's because everyone is selling volatility, selling options, or other people look at zero DTE and say, maybe could 0-day options, given they've, now 50% of the market, could they be impacting, the VIX level? So what I would say, and I have actually a paper specifically on that you can look at on the Cboe website doing a deep dive, is that on the margin, like vol selling strategies obviously have an impact, but I don't think these are the dominant reason or the main reason why volatility is low. And the reason I think that is, number one, low volatility is not specific to just US equities, right? It's not just specific to SPX. We see it in emerging market stocks, we see it in European stocks, and more importantly, we see it actually across asset classes. Credit volatility is currently at a 10-year low. If you look at commodity volatility, that's also extremely low. FX volatility, currency volatility, everything across the board has come in terms of volatility. And that to me suggests that really the main driver of the low volatility environment that we're currently in is macro fundamental. It's the fact that, in the span of the past 18 months, we've gone from everyone expecting a recession, pricing for hard landing, to now, a soft landing looking more and more likely. And that, I think, is the reason why you're seeing kind of volatility levels really decline across the board.
So yeah, that's really a great answer, and I think a lot of people are really interested in that. The other, you got into the cross asset volatility, and I've already got also a question for you, for myself and the user, about that one. Is we recently saw, when rates started moving up and the inflation started moving up a year or two ago, we saw some really big time volatility in the rates market and relatively suppressed volatility in the equity market. It didn't fall, or there was not as much correlation. First, I want to ask you why that is. And then I have another user asking they want to know about what's coming up with the Fed, and and the Fed may be at an inflection point. We saw some soft CPI numbers today. What is the expectations for rate volatility bleeding into equity volatility in the second half?
Yeah, no, these are great questions. So for sure, if you look, starting at the beginning of 2022, we've seen a huge repricing higher of interest rate volatility. Whereas, in 2022, VIX did go up, right? It was trading mostly in the mid 20s, but it didn't go up nearly as much as, interest rate volatility. And since then, obviously, equity volatility is now back down. VIX is back down to 12. So a lot of questions around that. I would say it really, you have to think about what drives interest rate volatility and what drives equity vol, and they're not the same thing, right? So what really drives interest rate volatility? Two things, right? Fed policy and inflation. And we had incredible amounts of uncertainty on both fronts in 2022. And the other thing is, when you evaluating high or low, people tend to look at say, historical levels, say, over a period of 5 or 10 years. And let's say 10 years, it's like a pretty standard long-term history that people look at to see where if the current level is, rich or high or low compared to the 10-year history. Keep in mind the 10 years that we had prior to 2022, coming out of the global financial crisis, there was no inflation risk, and there was basically no Fed policy risk in the sense that rates was, for most part, pinned at zero, right? So I would actually argue that the 10 years that we had post-global financial crisis, that was the abnormal period in rates volatility, and that what we're seeing right now when we have real inflation risk as well as real uncertainty around Fed policy, that's a more normal environment that we just kind of forgotten because of more the recency bias, right? So if you compare actually levels of interest rate volatility to today to where it was trading, say, prior to the global financial crisis, in the early 2000s or in the 90s, it's actually equivalent or even actually pretty low compared to where it was trading at that level. It only looks extremely high when you compare it to the previous 10 years, which was, very much an environment of zero interest rates and zero inflation. And then the second thing in terms of, I think the part of the question is, can we look forward? What's the expectation of kind of rates vol bleeding into equity vol with potentially softer CPI and Fed cutting rates? I think a common misconception, and certainly in the narrative, is that Fed cutting rate is good for equity, so should mean lower levels of volatility in the market. If you actually look at it historically and in the past 5 or 6 rate cutting cycles, the track record for stocks is actually pretty mixed. A little under half the time, stocks actually have sold off on Fed rate cuts. And that really comes down to whether or not the Fed eases in time. If the Fed eases too late, meaning the economic growth has already slowed dramatically and we go into recession, that's typically not a good environment for stocks. You actually have stocks down and volatility higher in those environments. Whereas sometimes, in other cases where the Fed eases preemptively and aggressively enough to ward off a recession, then yes, volatility can be lower and stocks can do well in that case. But it's not at all, it's actually pretty mixed in terms of the track record.
Yeah, I've talked a lot about that in some of my other webinars. The idea that when the Fed cuts first, people get excited. When there's more cuts than they want,
exactly,
maybe there's a reason they're cutting, and that reason might not be very good, and it might have to deal with the economy.
And the historical data exactly backs up your point. Yeah.
Yeah, and speaking of that, you spoke a lot about that the VIX future curve, and I had a few questions on that as well. And the first question, that was we saw a big 2.5 vol gap in the October one, and so I had a user say, well, why isn't it November? Why is the gap in October?
Yeah, that's a great question. So keep in mind that the October VIX future, when it expires, right, it's going to expire to the VIX level then, and the VIX itself is a 30-day forward-looking measure of volatility. So in October, when it settles, it's going to settle into what the markets expect volatility to be for the next month. So from mid-October to mid-November, right? So that's why it's the October future that captures that October to November implied expectation and not the November future, because by the time the November future expires or settles, it's going to settle into the VIX index in November, which is going to capture the implied expectation for November to December. So that's something that you have to keep in mind is the forward-looking nature of the VIX index itself, which is why you're seeing that bump right now in the October VIX future. But it's interesting to me that the November future is lower than October because we would talk about potential like contested elections or things that could drag out volatility for longer. You're not really quite seeing that in the market right now. So it'll be interesting as we get closer to the election. I know there's a lot of noise and a lot of risks and uncertainty around the election right now. But that's something, again, to watch the October to November future. If that does change, could that signal, expectations of people, potentially hedging for a contested election?
Yeah, that's a very good point, and I see as the political polls move around, I think you may see some changes in that VIX curve and how it operates. The other question I had regarding, and you answered it a little bit, and I want to delve into it a little bit further, is that 2.5 vols. You had said the last time it was about a vol difference And someone asked, is 2.5 kind of average or is above average? My follow-up question on my side is, what about the absolute VIX levels and the idea of mean reversion? And maybe you could talk a little about what mean reversion is, and does volatility mean revert?
Yeah, so volatility is a mean reverting asset, and that is a very important point when it comes to trading VIX-related products, particularly, I would say, VIX options, because what it means that when, like, say, a lot of times the popular trade in VIX options is people buy VIX calls, they expect a pop in volatility, they get it. Now, the problem is that they hold on to it and vol mean reverts, or VIX mean reverts, and comes back in actually very quickly. And if you didn't monetize it quickly enough, you actually end up not making money on your trade, even though you did get that pop in volatility that you were expecting. So that is something that's very important to know, and actually really important to emphasize when trading the VIX, is that because volatility is a mean reverting asset class, it's not when you're trading volatility, whether it's VIX futures or VIX options, it's generally not a buy and hold strategy, right? It's not something that you put in your portfolio and you can walk away, forget about it, and come back, a month or 2 months later and close out the position. You have to actively track it, and you have to be ready to monetize or trade out of it if it starts to move in your direction, because it tends to be quite short-lived. Now, that said, there can be periods of sustained high vol, like kind of we saw in March of 2020, where VIX, went from, I think, late February all the way into up to June, above 30. So I would say generally VIX above 30 is what I would consider high volatility. So you could have periods of multiple months of high volatility, but that does take a once in a generation, or hopefully once in a generation type of event.
Once of a generation that happens every 5 years, right?
Exactly. Yeah, exactly. But if it's something like more of a run of the mill type of sell off, then yeah, like if you look at last October when markets sold off, the VIX spike that we saw was very short lived.
Yeah, that's great information. The other, getting a lot of questions about implied versus realized, and one of the questions I really liked, in paraphrasing basically, is implied volatility is a measure of what people think it's going to be. So it's just a prediction, right?
Yeah.
So how accurate is the VIX in terms of it goes out 30 days? How accurate is it in capturing realized volatility?
So, I mean, I kind of alluded to earlier, but there is, because of supply demand dynamics, where you generally, especially index products, right, you generally have more hedgers out there that are bidding up the price of protection, the price of volatility. There is that volatility risk premium that tends to be positive. So in that sense, it's not that accurate, in that the VIX has a track record of overestimating, if you will, what subsequent realized volatility is going to be. And that's really just kind of why people trade options, right? We tend to have more hedgers and more buyers of options out there, and the sellers of options, given the convexity and the asymmetry of the product, they demand that extra premium in order to be a seller of an option, or a seller of an insurance, if you will.
No, that's really good to know. And so then the follow-up question to that is, being that implieds a lot of times are trading richer than realized volatility. What types of option strategies can be utilized to try to take advantage of that by traders?
Yeah, so that's a great question. So the products I mentioned today, VIX futures and VIX options, are ways to trade implied volatility, right? They don't really give you exposure to the realized volatility component. And as I mentioned, there are a very active vol community out there that try to actually capture that difference between implied to realized. And the way to do it, again, there are many ways to do it, but probably the most easily accessible way is through trading delta hedged straddles or strangles on the underlier. So in this case, for example, SPX, right? So basically what they try to do is they try to take out the stock directional moves of the stock. So they'll buy a put, buy a call, same strike in the option, right? So they're long vol because they've long both the put and the call, and they'll sell the delta, like however many shares, well, the trade will be delta neutral at inception, but then as the stock moves, right, and you get the delta changes, they'll try to neutralize that. So all they're exposed to is the vol component, is the realized volatility component. So when you do a trade like that, and again, this would be fairly complicated and complex, and operationally, it would take a lot, for investor to do on a daily basis. But when you do a trade like that, you capture that implied to realized spread.
All right, no, that's a good way to know it. The other question we get a lot here is about skew. And first, I just want to kind of maybe we haven't touched on in your presentation, so maybe you could just give a brief explanation as to what skew is, how it usually acts, and how it's acting now.
Yeah, sure. So skew essentially just measures the demand for puts versus calls. Just think of it very simplistically. So think of it as almost like a sentiment indicator, right? So when skew is very high, it means there's a lot of demand for puts. People are bearish. There's a panic in the market. They want that protection. When skew is low, generally it means either lack of demand for protection or actually people more focused on buying upside calls and positioning for a bullish move in the underlying. Now, for something like the S&P index itself, skew generally tends to be positive, meaning that puts trade at a premium to calls. Puts are more expensive, as I mentioned, because predominantly people buy index options for hedging purposes. But what is interesting right now is that if you look at S&P skew, it's actually near record low level. So there's actually not a ton of hedging interest in S&P, which is interesting because I talked about the hedging interest that we're seeing in VIX options. So people are interested in hedging. They're worried about that black swan event, but they're not really interested in hedging using SPX options, which typically is more, for protecting against like a moderate drawdown. So they're not, I would say right now, I would say investors are not concerned about a 5 to 10% pull down, a drawdown, but they are worried about a black swan event that could potentially trigger, like a 20% sell off in the market.
Yeah, and part of that may be because the actual realized skew has been very much to the upside recently. Can you talk a little bit about that?
Yeah, so that's a great point. So part of why skew exists in index options obviously is based on historical market behavior and the fact that sell-offs tend to be a lot more volatile, a lot more vicious, right, than the upside moves, right? So the adage, the market takes the escalator up and the elevator down, so it always crashes lower but grinds higher. And what's been interesting is over the past year, it's been the opposite. The more volatile days have actually been market up days. So the market's been really taking the escalator down and then the elevator up, if you will. So it's really melting up versus grinding lower, which is the kind of complete reversal of the historical expectation. And I think part of what is driving that is positioning, right? So a lot of people came into the year, particularly last year, very bearish. That was kind of like the consensus that we're going to a recession. Everyone was underweight stocks. And then as the year progressed, we didn't get a recession. We got a soft landing. Plus, then you have, the thematic, the secular themes like AI and those stocks really, pulling the market higher. And people were really not positioned for that and having to chase the market higher and using options to do that. So there was a lot of demand for the upside calls than you typically see.
Yeah, and so to me, what was really fascinating, I read one of those articles you talked about this realized skew really being to the call side, something that I might expect this year and in last year, but it was also like that in 2022.
Yeah.
And was that because of short covering more likely, or is it a different reason, or is it the same kind of reason?
It's slightly different. So in 2022, I would say skew was very low, not because people were buying upside calls and chasing the upside, but just that people stopped buying puts and stopped buying puts because they were actually deleveraging by moving to cash. So that's something important to remember is that people buy protection when there is something to protect, right? But when you're selling out of stocks and moving to cash, you don't actually need to spend the premium to buy puts. So in 2022, skew was very low, not because people were bullish on the market, but because everyone had kind of thrown in the towel and was moving to cash.
That's great. And I have one last question about skew and I have a bunch of questions here that people like to ask about zero DTE. What does the zero DTE skew usually look like? Is it more volatile? Is it much different from a 1 week or 1 month skew? What's kind of the skew profile now and generally for zero DTE,
So
SPX type thing?
Zero DTE options, I would say they're almost like a special animal in their own right, in the sense that I talk about, generally speaking, index options, we see more hedgers out there. So there's always a positive skew, more puts trade than calls. We don't see that in 0DTE. 0DTE is very balanced. And I think that's the most surprising thing to a lot of investors. If you look at the put to call ratio, the volume, it's fairly balanced at 1-to-1 on almost every day. And if you look at the skew in 0DTE, it's also very balanced. So there's not a persistent demand for puts like you would see for like a 1 month or a 1 year option in S&P. For a 0-day option, it's extremely balanced. And I think it's because a lot of people trade 0DTE to capture intraday trends rather than longer term trends. So you could be longer term bearish, but on an intraday basis, like, markets can move, many different directions. So I think people trade it intraday and they trade it very tactically, very dynamically. And we also see a variety of users in 0-day options, not just hedgers, but people who sell 0-day options for income. We have momentum chasers. We have people who play mean reversion in the market. So the diversity of strategies that are being deployed in 0-day options, I think, is why the volume and the skew in 0DTE options is so balanced between puts versus calls.
Well, Mandy, it's been really great having you on this webinar, and hopefully we'll have you on again, because I feel we've only touched the surface. And unfortunately for all your viewers out there, I have a ton of great questions we're not able to answer. But thanks so much for being here. Any parting thoughts, anything you want to tell us upcoming on new products related to volatility?
Yeah, sure. So, given the focus is on volatility, I think it's worth mentioning that Cboe, we're constantly innovating and adding new tools to our volatility toolkit. So everyone obviously familiar with VIX, VIX options, VIX futures. We're actually introducing later this year in September variance futures. So when I talk about before that current products only give you ways to play implied volatility, variance futures is actually a very neat and clean way to capture that implied to realize volatility spread. So that's a product that we're going to be bringing to market, to the listed market. It's a product that is very active in the over-the-counter market, but we're bringing it to the listed market, making it more accessible for investors to trade. And then the second thing worth mentioning is VIX options on futures, which, without getting to the technical details about the product itself, I will just mention it's going to give a way for investors to trade more shorter dated options on VIX. So, kind of bring that 0DTE trend or the 0DTE capability, if you will, to VIX options later on this year.
That's great. Thank you so much. And hopefully when those new products do roll out, we can have you on the webinar again to learn a lot more about how they work and the nuances around them. But thanks again. And for anyone that viewed the show, please tune in next month. We'll have a new guest from the Cboe about a new options topic. Thank you so much.
Thank you.